Thank you for joining me for this presentation. My name is Brad Renard. I'm the Chief Investment Officer for QTR Capital Management and the sister company Upside Options. It's May 27th, 2019, and this presentation is entitled Best Strategy for Today's Volatile Market. Make 2.5 to 4% per month, minimal risk during market sell-offs. The questions I will address during this presentation: how do the major charts look and what are they telling us? What are the probabilities of this market going lower? What is the best investment strategy for 2019? And that's where I'll talk about our non-directional strategy. We call it Pinnacle, and it's focused on writing call spreads. So it has minimal to zero risk when the market sells off or trades sideways and choppy. Why? Because we focus on selling call spreads, which I'll discuss in more detail. And it has similarities to selling covered calls against stock, which brings in premium. Our strategies that we offer through QTR Capital and Upside Options: we offer non-directional income generation strategies, and we also have long-short quantamental strategies that blend technical, fundamental, and quantitative analysis. We have big cap growth. We have small and mid cap growth. We have contrarian that buys stocks that have been out of favor for 6 to 12 months and are starting to recover. We have sector rotation that concentrates in strong stocks within the strongest industry sectors. And then we have Iron Condor Pinnacle, and that's what I'm going to primarily talk about today. It's a non-directional strategy. It primarily writes call spreads against the S&P 500 index, the SPX, generates about 2.5 to 4% per month for most months out of the year, and it has minimal to zero risk when the market sells off. And we do have free trials available on the website at www.upsideoptions.net. Our differentiation: we do 4-level quantamental analysis where we blend technical, fundamental, and factor-based quantitative analysis. Our strategies are long-short, where we can make money in both directions. We follow strict exit rules, where we're able to let most winners run, but our exit rules are fast enough to lock in gains and to protect capital. So for example, in October 2018, we went from 75% allocated to 15% allocated in about 6 days. And as a result, we finished 2018 with solid gains of plus 14 to plus 18% gains for our strategies, and the benchmarks such as the S&P 500 index and the small cap index all closed 2018 at -8 to -12% returns. So we did very well for 2018. Our strategies are managed by traders that are nimble and fast moving, and traders that follow exit rules decisively. To define what our 4-level quantamental scanner is, we start with a macro level analysis, broad-based technical, breadth, fundamental, sentiment, and that modulates our bullish and bearish exposure levels. We then do a technical scan, and we're looking for high probability setups for both bullish and bearish trades. We then do a fundamental screen, so we're looking for strong companies for the bullish trades and weak companies for the bearish trades. We do a quantitative screen that provides probabilities of a bullish pattern or a bearish pattern following through. And then we use technicals to trigger our entries and our exits. Here's the chart of the NYSE Composite Index. And the first thing I see is a very bearish signal. I see lower highs with a downward sloping trend line, and I see lower lows, creating a downward sloping trend line. This chart pattern, it's very bearish, and it sends a signal that this market can go lower, especially if we continue down the path that we are with China trade, if the economy continues to slow, if earnings continue to stay flat or deteriorate further. This tells me that this market can go lower. Here's a chart of the S&P 500 index. This one doesn't look as bad. Actually, I see a higher high. So this was the January 2018 high. Here's the October high, which is a higher high, so that's good. I do see a severe sell-off. Now the sell-off would have been relatively orderly. What happened is that we failed below this breakout level of 2873. And once that happened, all the machines kicked in, a lot of the hedge funds kicked in and sold off. So we came back down to the support level. And then unfortunately, we sold off even further, and this was due to the Fed. The Fed actually was sending a signal in late December that they're on track to continue to raise rates, and the market did not like that at all. So we ended up, unexpectedly, we had a very bad sell-off right through Christmas Eve. It rebounded. We can see we went right back up to the highs. We took out a double top, and now we're back down in this range, around 28.26. This tells me that the probabilities are increasing that we are not going to break above 29.30 for many months, if possibly for the rest of 2019. So what's the best strategy with these volatile bearish charts? Stock picking can still work. There's always something going up. So it takes a lot of experience and time, especially in this choppy, volatile market. You should follow strict exit rules. That's what we do. And you can easily get chopped up in this market. So you need quite a bit of experience, and you have to put a lot of time into it. The best strategy is a non-directional option selling strategy, where we focus on selling call spreads against the SPX index. That's the S&P 500 index. It has similarities to selling covered calls against a stock position, which brings in premium. And that's a pretty popular strategy that a lot of people use. There's a low probability that the SPX is going to break back above 2930 for many months, if not for all of 2019. That's the reason we're making the bet that we can continue to write calls up near 2930 and continuously bring in premium. You can make 2.5 to 4% per month as the SPX index trades sideways, choppy, or even sells off. This is a conservative implementation with capital preservation, and safety is a top priority. We hold a maximum of 3 call spreads at any one time, and that represents a 30% exposure of the portfolio. So if it's a $10,000 portfolio, we're putting $3,000 to work. And it has a low to zero risk when the market sells off. This strategy is conservative by construction, which allows us to sleep well at night, but we're still able to bring in excellent monthly gains. And it generates cash flow for people who desire the monthly cash flow. Here's what a bear call spread looks like. This is a risk-reward graph for an options trade. On the left side is an index. This actually happens to be the Russell 2000 index, the RUT. Here's the index here as a function of time. And the black line represents where the index closed as a snapshot of when this chart was made. So this RUT closed at 680. And on the right side is the options trade. Anything to the right of this vertical line represents a gain for the trade in dollars. Anything to the left of the line represents a loss for the trade. And you read this option chart by using the lines, and this is as a function of time. So in this particular case, we opened up a 740, 750 bear call spread. So we sold the 740 call, we bought the 750 call, and it's above where the RUT is currently trading, which is around 690. The objective is we want the RUT to stay below the short call that we're writing. And this particular trade had 55 days until expiration. So right at 55 days, you would be riding on this red line. And you can immediately look at it and say, okay, the value of this option trade actually is in a losing position right when you open it. So you're down about $50 to $100. Now, as time progresses, for example, when you're 29 days left, you're on the green line. And as the RUT stays down in this range, you can see now you're in a profit. And then the black line represents the trade at expiration. And in general, for these trades, that's all we want. We want to run the trade through expiration. Anything to the right of the vertical line tells us that's a profit. And you can see this is the premium that we collected when we first opened up the trade. So let's look at the trade again. We opened up a 740, 750 bear call spread. The trades that we open up for this strategy are open for 2 weeks, not for 55 days, for 2 weeks. The call spread brings in a credit of $1.10, or about $100 after commission for quantity 1. For example, using this type of risk-reward chart, the line over here represents $100. So as long as the RUT stays below the short call that we sold, we'll have the $100 of profit that we collect for the trade and keep. Broker holds $1,000 of maintenance for this trade. Potential return is $100 that we've collected after commissions divided by $900 of risk capital, or about 11% return. We do it twice monthly because each trade we open up is open for 2 weeks. So we can bring in a total of $200 per month with a quantity 1. If we were to open up quantity 2, we'll double that. So now we're collecting $400 per month. And for a $10,000 portfolio, if we're collecting $400 per month, that's about a 4% return. And in this particular case, we're showing a 20% portfolio allocation. Again, for a $10,000 portfolio, we're opening quantity 2. That represents $2,000 put to work. That represents a 20% portfolio allocation. So let's look at the SPX specifically, because this is what we're writing calls against. So this is the S&P 500 index. We're zoomed in a little more. Here's all the levels that we're working with. We have 2930 up to 2940 as the high. Looks like a double top. It did attempt to break up through, but it failed. We have a 2873 line right here. This represents the January 2018 high. We have a 2815, which represents this level here of support. That's where the SPX is currently trying to find support. Here's the 200-day line. Here's the 50-day line. This is the 13-day EMA. This isn't good. 13-day EMA is ready to cross down through the 50-day EMA, and that's bearish. That's intermediate term bearish. Then we have two more support lines down here. We got a round number around 2,700, and then we have a 2,640 representing this level here. So we're selling to open, STO, selling to open the 2930 call, buying to open the 2940 call for protection, creating a 10-point wide spread. This is what it looks like here, SPX 2930, 2940 call spread or bear call spread. Spread brings in a credit of about $1.10 or about $100 after commission. We open up quantity 2 twice monthly. Thus, we're collecting $400 of premium per month. For a $10,000 portfolio, that's a 4% return. And we allocate 20% of the portfolio. And we will adjust the trades if the SPX breaks up through 2930. So the best strategy for 2019 is write call spreads against the SPX. Writing call spreads against the SPX should do well for most or all of 2019. It generates 2.5 to 4% per month, and we have minimal to zero risk when the market sells off because we're focused on writing the call spreads and we're avoiding the put spreads. I'm just reminding everyone of what the NYSE Composite Index looks like, and that's a very bearish chart. That's telling me that the probabilities are very low that we're going to be breaking back above 2930. Where's this market going next? If the China trade war grinds on, it will slow U.S. and global growth. So that increases the probability that a recession will hit in early to mid 2020. It also increases the probability that the SPX will break below the 200-day line and test 2640. That's a drop of about another 7%. And recessions usually cut stocks by minus 30 to minus 50%, as a reminder. Currently, the U.S. economy is okay. It's actually pretty strong. Jobs growth is strong. But earnings growth came in flat for Q1 19, and they're projected to be flat again for Q2 of 19. The bond market is still pointing to a slowing economy because we have a flattish yield curve, and it actually inverted. And the bond market is classified as the smart money. It's usually right. The NYSE Composite chart is sending a longer-term bearish signal, as I showed, with lower highs and lower lows. The S&P 500 index will probably trade range-bound above the 200-day SMA, near 2775 and below the all-time high of 2930 for many months, if not for all of 2019. Thus, the reason we're talking about the Pinnacle strategy as the best strategy for 2019, where we're writing call spreads up near 2930. However, if the NYSE Composite can break back above its downward sloping trend line, then it will send a much more positive signal. So it's just something we have to watch. So just a reminder, here's the NYSE Composite, and we have a level here of 13,246. And if this index can break back above this downward sloping trend line and get back over 13,246, then it will send a much more positive signal about the stock market and the U.S. economy. Okay, that's it. Thank you very much for your time. And if you would like to view our weekly analysis, which is very robust, has about 45 to 50 charts in it each week, please go to upsideoptions.net/weekly market update. And we have free trials available at upsideoptions.net/free-trial. Thank you very much for your time, and I'll see you next time.